we've actually seen probably one of the most significant outperformances of the small and value market relative, again, to more growth-oriented names. And for those of you who are invested using a biblical responsible investment or portfolio, this is actually potentially very good news for you, as these portfolios tend to favor more small and value-oriented names, more like mid and small cap names. Welcome to Life in the Markets. Today is July 6, 2026. My name is Tim Russell with the Life Financial Group, where we help Christians become even better stewards of all of their assets. Today, we want to give you a mid-year review. So we're doing a little bit of a look back at the past 6 months and a little bit of a look ahead for what we can expect in the coming months as we wrap up the rest of 2026. First, before we get into all of that, let's just review where we are in the markets over the past few days and now looking at year to date. Notice that last week was a shortened trading week, primarily because of the 4th of July holiday. Even though the 4th fell on a Saturday, Friday was treated as the observed day for the holiday, so the markets were closed. The S&P 500 had a fairly decent week. In spite of some volatility, we ended up having a 1.76% growth over the past few days. The equal-weighted S&P 500, we're going to talk about this a little later, was up just shy of 2.2% over the week. So equal-weighted outperforming the general S&P. NASDAQ had a somewhat muted week, only up 0.75%, 0.72. Russell also somewhat muted, 0.2% positive for the week. The international market seeing some rebound, 1.78% positive. Gold was up, silver was up, oil, praise God, oil was down. This number that I pulled for oil, actually I pulled that last night. So Friday was actually even lower than the number you see here. I guess this would have been Thursday. The number was even lower than what we see here. But we're seeing oil trading at $68.77 a barrel, which is really wonderful. Everything in context, right? Relative to $120 a barrel, I'll take $76 or $68 a barrel any day. Bitcoin was up a little bit. Ag bonds were down. High yield bonds were down. Treasury was, not surprisingly, up. As we look at where we are now, just on a 6-month basis, again, we're looking year to date through Thursday. So it is a little bit of a little extra information, not just the 6 months, but we're seeing that the S&P 500 is up 9.3%. The equal weighted S&P 500 up 12.2%. The NASDAQ up almost 21%. The Russell 2000 up 21%. The international market was up about 8.7% over the past 6 months. Gold was down. Silver is down. Notice silver is down pretty sharp. Last year, silver had one of the most remarkable years just in terms of growth and its value, which is how it even started to show up in this weekly tracking that we do. And now we're seeing silver down about 14%. Oil, in spite of the fact that we have seen oil come down, we're still 20% higher than where we started at the beginning of the year. So we have more work to do in the oil realm. Bitcoin is off about 28%, 28.5% from this year. Bonds. Bonds are down 1.25%, 1.2% for high yield bonds. This is something, again, we continue to watch. A lot of this is because of the inflation expectations and now additionally concerns of rate hikes. Those two things are connected. If we are concerned about inflation, we're also concerned about the likelihood that the Fed may seek to reduce inflation by increasing interest rates. And again, not surprisingly, 10-year Treasury yield is up 7.3% since the beginning of the year. All of these things matter to investors. So let's look at what's actually driving the overall markets the past 6 months. I'd say, if anything, the markets have been responding shockingly well this year, in spite of all of the kind of trauma and drama that the markets have encountered between, we've got Maduro capturing the Venezuelan president and, holding him now for trial. We've got the whole war with Iran. We've got a number of other factors connected to the oil with the war with Iran. Oil up around $120 a barrel. It spent 30 days. The West Texas index spent 30 days, a little bit more than 30 days, at or above $100 a barrel. If we look at the more international oil prices, those spent, in some reports I've said, over 100 days above $100 a barrel. So oil was certainly a major part of what drove the markets this year. And yet, here we are, we've had about a year's worth of returns in just 6 months. In spite of oil, in spite of war, in spite of uncertainty, in spite of unrest, in spite of there's never been more sourness and dourness about the health of the economy or how everything's going to hell in a handbasket here in America. The markets don't seem to show it. Consumers and their habits don't seem to show it. Kind of discount what you're hearing about how bad things are. Don't listen to what people say. Listen to how they act. The markets, earnings, corporations around the country, around the world are healthy and strong right now, and that should give investors some encouragement. There are a number of factors that have been driving the markets, and one of the major factors, I know you can already anticipate it, it's the AI bubble that people are looking at, saying it's a bubble, it's going to burst, it's going to cause a problem, and the related concern about AI causing massive unemployment. And while we've talked about this here on this channel a fair amount over the past number of months, the reality is it seems like the majority of the worries about AI just coming for your jobs seems overblown. We're not actually seeing it show up in the data. So we have had a number of AI-related layoffs. So here's some big companies that have cited AI as a reason for laying off employees. Oracle, Meta, Microsoft, Amazon, Cisco, and there are plenty of others. Those are some of the bigger names. All of these companies have had layoffs, and yet the firm Challenger, Gray, and Christmas, in their May jobs update, showed that there was actually 87,700 some odd jobs that were lost due to cited reasons being AI and AI-type concerns. That's really interesting. We had, I think, the total number, and you'll see on the chart, was nearly 400,000 layoffs, and only 87,000 of those 400,000 jobs were lost due to AI. The bottom line here is AI is having some impact right now, and it's arguable that it could become even more significant the more entrenched AI gets, but the reality right now is AI is not in any way the driving or most significant factor in terms of overall percentage for the way unemployment is coming into the market. In fact, what we're seeing as we're looking at the rest of the unemployment picture is that the unemployment picture is improving. So this next chart I'll put up here on the screen comes from the JP Morgan Guide to the Market. And I love looking at this every single quarter. What it shows here is that non-farm payrolls is actually improving. We're adding more people to payrolls more than we're taking off of payrolls. So again, AI may be a factor. It may become a bigger thing, but right now, people are finding jobs who want to find jobs. There are lots of companies out there who are still hiring and looking to take advantage of growing business demand by hiring more employees to meet and serve those needs. So AI might actually create some more opportunity for business to pick up quality people that may have been let go from one company or another because of AI to join their ranks to actually accomplish what they want to do. This is a fundamentally good thing. Again, don't mishear me. I'm not saying that people getting laid off is a good thing. I'm saying that the fact that the employment market can absorb the losses and can process those jobs, that is a very good thing. One of the other factors that we're seeing this year is that large cap, mega cap companies have kind of lost their luster this year. We're seeing that so many of those companies driving the S&P 500 that have been so very profitable for the market, driving most of the returns over the past 3 years, this year have had very muted returns. So we have talked about this again on this channel a number of times, but the Magnificent Seven, and to remind you, the Magnificent Seven are NVIDIA, Meta, Tesla, Amazon, Alphabet, Microsoft, and Apple, right? These 7 companies, they're quote unquote magnificent. And I don't even love that phrase because they will certainly go in and out of whether they're so magnificent or not. Well, right now, they're really not that magnificent. So the next chart I'm going to put up here on the screen shows the Magnificent Seven. And what it does, in particular, the chart on the right shows that the actual rate of return, the price return of those 7 stocks in 2023 was amazing, well in excess of the green bar, which is the S&P 500. In 24, same story. In 25, pretty close to the same story. But take a look in 2026. There's only one of those companies, one of the one of the Magnificent Seven that's actually above the rate of return of the S&P 500. So the Magnificent Seven is a little less magnificent in this year. So again, this is part of the reason why just jumping on the bandwagon of companies that are growing may or may not necessarily be the best long-term solution, because what comes up must come down at some point. This is why here at the Life Group, we recommend a really solid, diversified portfolio that actually is able to weather a variety of market conditions. Right now, these particular companies are not quite so exciting. And then the inverse of the Magnificent Seven not being quite so magnificent is that we're seeing small cap companies, value type companies showing signs of life. We've actually seen probably one of the most significant outperformances of the small and value market compared to other periods of time that we've seen, relative, again, to more growth-oriented names. We like to see that smaller companies, more medium-sized companies are doing well, getting the kind of love that they deserve in the markets. And for those of you who are invested in a more biblically responsible way, using a biblical responsible investment or portfolio, this is actually potentially very good news for you, as these portfolios tend to favor more small and value-oriented names, more like mid and small cap names. So these, again, very positive signs. Now, we've already talked about oil. We've talked about how it's been so elevated for so long. One of the major stories of 2026 has actually been the fear of inflation and the lingering effects of inflation, causing more worry to persist within consumers. And there's no way around it. Inflation's a problem. It has been a problem. It probably will continue to be a problem as long as oil stays elevated. The one thing I think for me is encouraging is as we're seeing oil come down from its very high levels, and honestly, it's come down pretty sharply over the last month or two, that helps to take a little bit of pressure off of inflation. So as we look out at the next couple months, as long as oil keeps on moving in the trajectory it's going, there's not a lot of other factors right now that are driving inflation higher other than oil. So pay attention to that. As we wrap up the video, I just want to give you maybe 6 takeaways from the first half and a few things to think about as we move into the next 6 months of this year. The first takeaway is investors need to keep a long-term perspective in mind. As they invest in their portfolios, they've seen a really good return in the first 6 months. First of all, you should be encouraged by it, but don't be too encouraged by it. The markets go up and the markets go down. I have no idea whether or not we're going to have a repeat of the first 6 months and the second 6 months. That's honestly, it's irrelevant to me. It should probably be irrelevant to you as a long-term investor. Don't give too much credence to the short term. Focus more on the long term. That is where wisdom is on the investing side. The second point I'd like you to remember is if you have money that you know you're going to need from the markets, if you're replacing a vehicle, if you're going to be doing something on your home, now would be a good time to pull some of those funds out of the market to put towards cash. Again, not trying to time the markets, but recognizing that the values are pretty healthy right now. There's no guarantee of the future. If you need those funds, make sure you use them when the market is up. That's wise. Thirdly, pay closer attention to your own financial situation, your budget, your debt, your savings goals. Pay closer attention to that than you do to what the news media is telling you about the economy or about how you should be feeling. The motivations of the people who are driving the media, who control the media, are not always interested in what's best for you. In fact, this is one of the things that for me as a financial advisor is so frustrating because there's so much good happening in the broader economy that if you just watch the news, you'll think that the world's coming to an end and everything is just dour and sour. Don't waste your life complaining about what's going on. Don't waste your life complaining about what's happening with, what you see on the news media. Disregard it. Turn them off. Focus on things that matter to you, your life, your family. Those are the things that truly matter. Fourth, of keeping up the same theme, please disregard the news media leading up to the midterm elections. So leading up to, during, and even after the midterm elections, this is a hyped news environment that we're in. And I'm not really convinced that paying that close attention to all that is going on with the midterms is going to be helpful for you. I do want you to vote. I do want you to get out there and vote your conscience, do the right thing. But again, don't think so much about the short term, about political outcomes, about election outcomes, that you forget the bigger picture of your own financial situation, your own stewardship goals. Fifthly, for those who are still in the workforce, if you're worried about AI, first of all, use it as a good tool. Don't hate it. It is a tool. It can be used. It can be used well. So learn to use it well and invest in your own skills and abilities to become even more valuable in the marketplace. Again, if you're concerned about losing your job because of AI, be more valuable. Be so valuable that they can't live without you. You have been created with the image of God within you, which means you are valuable. Lean into who you've been created to be. Be the value that God wants you to be. none of the rest of the stuff with AI is, at the end of the day, ultimately going to matter, because you have worth, dignity, and value. Live into that. Show up every day and provide the value to your employer in your place of work. You will be okay. And then finally, for those who are in retirement, this is a really great time for you to share your wisdom, the wealth of experience and knowledge that the Lord has given you over your career. Share it with the next generation. This is wisdom. We need your wisdom. Don't hoard it to yourself. Share it with others. The world will be a better place. As we wrap up today's video, I want to close with a verse to remind us and to encourage us. This comes from Matthew 22, verse 39. And it simply says this: love your neighbor as yourself. This is the Christian ethic. This is how we live our lives. Live our lives to love and serve God, and live our lives to love, support, and serve our neighbors. Brothers and sisters, thank you for joining us in today's episode of Life in the Markets. Remember to reach out to us if we can help you become an even better steward of all of your assets. We would be honored to work and serve you. Until next time, take care, God bless, and be safe in the markets.
The topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. All information herein is from sources believed reliable, but is not guaranteed for accuracy or completeness. The team assumes no liability for any errors, omissions, or actions taken based on this material. Information is as of the date stated and subject to change without notice. Securities and advisory services offered through Genius Wealth Management. Member FINRA and SIPC.